You're watching the program that identifies market trends, provides insightful analysis, and reliable research. Key elements to help you profit from the pros. Profit from the Pros is brought to you by Zacks Investment Research. Learn more by visiting them online at zacks.com. Welcome to Profit from the Pros. I'm Terry Ruffalo. Well, disappointing readings on manufacturing and jobless claims furthered investor worries about the U.S. economy a bit this week. Modest strengthening in the euro and a decent performance by some safe haven sectors like utilities and consumer staples helped to offset those worries a little bit, although a downgrade to Greece's debt rating kept Europe's debt issue on investors' minds. May housing starts fell a more than expected 10% from April, and building permits fell sharply as well. Bottom line, market remains range-bound. Our editor-at-large, Steve Reitmeister, now joins us with his thoughts. So because we are in this trading range, are investors focusing too much on negative news, do you think?
One could say that was the case when we were moving towards, down 9,700 and we bottomed there. And so now really, after a 700-point rally, you could say that we're almost in the middle of this range and the views of investors are becoming just a little more balanced, which I think is healthier. Here again, anything is better than going straight down.
Yeah. What's on your radar for the week ahead? Because we have a few good reports coming out here.
None of them I think are really game changers as far as next week. I think the most important thing is lack of bad news. Without another nation going south, without some other BP type oil spill, I think just that kind of calm would allow the markets to continue to move higher. So.
Okay, and when I say good, I really should have said important because we have GDP,
yes.
Housing numbers, and durable goods.
But it's final GDP, so it's really just minor revisions on that one. So it's not a fresh report. So
okay, let's shift gears a little bit here and look to you for some weekend wisdom. Explore with us, if you will, some of the potential outcomes for the economy and the market here going forward, and what maybe investors should be doing in each scenario. What are the scenarios?
Yeah, we really are kind of at a crossroads, and that's why there's so much diverse investor opinion about what's going to happen. So I kind of explored in this weekly piece what is the possibilities. What if we are headed back towards what they call a double-dip recession, or even worse, a depression.
Right.
On the flip side, what if this is actually a new generation of growth and prosperity, not unlike what we had in the late 80s and 1990s? What if we are on the footsteps of that, the doorstep? And then you have the middle case scenario. What if it's not so great, it's not so terrible, but we just kind of plow ahead, or what some might call a muddle-through economy? And so really those are the three potential outcomes. And I've laid out the signs to look for, which is most clearly going to be the case, and then how to profit in each of those scenarios.
Okay, case number one. If we get back into another recession, I'm not even going to say the D word.
Yeah, okay. But this is obviously the worst case scenario, and the signs to look for is that the main economic indicators, which are all now pointing slightly positive, if they start reversing course and going negative, whether that be consumer issues or retail or industrial or GDP, any of those kind of things heading in a negative direction, it's going to be very poor. Okay. We hear anything flaring up in the banking community, we got to be fearful of that. Deflation, that's what got Japan in so much trouble in the 1990s, and certainly we want to avoid a round of deflationary spiral. And because of the fear of deflation, governments have printed so much cash and issued so much debt that there's the fear that they overdid it on that side, and it creates inflation. Okay, so these are some of the potential signs to look out for that would spell for a very rough go here.
Okay.
So how you profit in the environment? Well, basically you just get out of stocks. If you're going to hold some stocks, maybe blue chips, but really it's just best not to be in stocks. In fact, flip it around. Short the stock market with ETFs and hold a lot of cash and gold.
Okay, what about if we go through the age of prosperity again?
Okay, that's the easiest one in which to note, because everything is just going in a higher direction. As far as the economic indicators, easiest way to see that is GDP of 3% or greater. In that environment, almost any strategy will work, and you go crazy on stocks. But if stocks are going to be going higher, then you can go more small cap, you can go more aggressive, you can go more speculative. All these different things will work out very well in that environment.
What about the muddle through?
Okay, so that's that middle case scenario, and that's just kind of GDP of 2% or less, and occasionally might fall negative. Consistently high unemployment would be some of the telltale signs. In this environment where the stock market is pretty much going to mirror the economy, it's going to go a little bit up, it's going to go a little bit down, and kind of nowhere for an extended period of time. In that environment, one can actually do well if they're selective stock pickers. And so I'd say, if it's more of a range-bound market, you can just look for stocks with the best estimates, higher allocation to large and mid caps. And if it's a volatile market, you can also throw in a little bit of market timing.
Quickly, which one do you buy into?
I buy into the latter one, the muddle through.
Oh, really?
Yes, muddle through scenario.
Between now and the end of the year?
For now and the end of lifetime. No. Now for the next 5 to 10 years. I think that is the most likely scenario with all the deleveraging that needs to take place.
All right, thanks for that. And thank you for staying with us here. Stay with us a little bit longer because we're talking about individual stocks up next on Profit from the Pros. Here is your Bull and Bears Stock of the Week. A couple of interesting picks as our Bull and Bear of the Week. This week, our resident research director, Shiraz Mian, with us once again to give us the lowdown on these two stocks. We'll start with the Bull of the Week, as we always do. Apple stock, the news was good all week, even at the end of last week. No surprise here that it's the Bull of the Week, is it?
No, it's not. And more so than the recent news stories about the company is the larger story, which is the transformation of this company with its roots in the PC industry into a consumer electronics giant. This company successfully moved into the mobile music device market, the iPod, then went into the smartphone market with the iPhone,
right,
and very recently in the tablet computer market with the iPad. Few companies in my analytical history has ever transitioned this seamlessly and effectively into these new product categories and effectively dominated them as Apple has done.
Well, the recent news, 2 million iPad sales recently, the iPhone 4 introduction just last week, and the huge flood of pre-orders for that product this week have really caused the analysts who cover the stock to readjust their target prices upward here.
Absolutely. In fact, just to add to that comment that you made on the introduction of the iPhone 4, which, let's not forget, iPhone came just 3 years ago and has dominated the smartphone landscape. On the very first day of taking pre-orders, the company took more orders on day one than in the entire history of the iPhone. The company sold about 20 million iPhones last year, 10 million in the first 2 years, and is expected to sell around 35 million in 2010. And given the reception that iPhone 4 got this week, my sense is that that 35 million expectation could be on the conservative side. You mentioned iPad, and I wouldn't be surprised if this tablet device becomes another winner for this company. And putting all of this together, we see this growth momentum showing in the Wall Street analyst estimates for top line and bottom line.
Okay.
We see continuous movement in earning expectation going up, and we have seen in the past that when estimates go up, the stock price follows.
Give me the quick scoop on the Bear of the Week, Wonder Auto Technology.
This is an under 300 million market cap Chinese auto parts supplier. It's very concentrated in the Chinese auto market, about 75% of its revenue, which it earns by manufacturing and supplying alternators and starters for the automakers, come from its top 10 customers, all of them located in mainland China. Our sense is that the Chinese market in general, the auto market, which had been growing at 10-15% annual clip over the last few years, is up for a slowdown in the coming quarters. And Wonder Auto, given its size, scope, and scale, remains more exposed to that macro backdrop than some of its peers. We expect that the top line, the margins, and bottom line has downside risk. We see some early sign of negative estimate revisions already in this small auto supplier. I personally wouldn't be surprised to see a 12-15% downside in the stock.
I got to leave it there. We're not through talking about stocks yet. Stay with us. And now, Stock Talk, analysis of stocks in the news. Well, the news just seems to be getting worser and worser, as they say, for oil giant British Petroleum, at least this week. Fitch Ratings downgraded BP for the second time this month, this time to just above junk status. Meanwhile, BP has agreed to put $20 billion into an escrow fund in order to help pay for the Gulf spill. On the heels of that news, then came word that the company cut their dividend for a time to help fund that escrow account. Here to look at this company with us from a value and technical perspective, our stock strategists Tracy Reinick and Michael Vodicka. So now the speculation is in some circles that the stock is a buy. But right. If you ask, I have a feeling 10 different analysts that question, is the stock a buy? You get 10 different answers, right?
You would. Yeah, I mean, from a value perspective, it's only trading about 5 times earnings, which is cheap by any metric, and especially in their industry where, you know, all their competitors are trading 10 times or more. Mm-hmm. So yeah, I mean, the stock, it looks juicy here from that perspective. But given the things you just said, you have these other issues about whether or not, you know, you're going to have any earnings coming down the pike because they have to fund this $20 billion escrow. Now, they don't have to fund it right now this year.
No, it's over time.
Right. It's over through 2013. So It's like $1.25 billion per quarter, which for a company that's producing this kind of cash flow that they are able to produce, that's not as big a deal as it might sound.
But here's the one thing that the investors were not waiting for, apparently, is that they're going to significantly reduce their investment program and sell assets in order to help fund that escrow account as well.
Right.
That was a surprise.
Right. That's a side thing that people have to be watchful over, because this goes to how they're going to grow the company and grow their earnings going forward. They are reducing their investments, their R&D and things like that by about $10 billion. So, as a person buying into a company, you have to look and see what you're going to get out in the future. And right now we know there's going to be no dividends and growth might be stunted a bit. So yes, it's cheap now, but there are some risks.
Michael, as far as the future is concerned, what are those technicals telling us?
Well, this isn't going to be a surprise to anyone, but it's basically a total bloodbath right now for BP shareholders. Shares are at a 15-year low right now. They're trading at about $30, coming down from $60, so they're already down 50%. Yesterday, they announced they're cutting the dividend, and we didn't see a lot of additional pressure on the share price, which was good for them in the short run.
Yeah, yesterday being Wednesday, because we taped this during the week, down 50% from the spill.
That's right, yeah, from the top. It topped off at about $60. And, we didn't see the share price take a hit immediately. The event happened on April 20th, which was a Tuesday, and not until April 29th, which was later next week, did we see the share price really start to take a hit and the market start to digest what was really going on. But
so is there a floor under the share price here that you can see?
Actually, interesting you should mention that, is that we do see a support level, a long-term support level at $30. Below $30, the next stop is about $20. So if it holds 30, they might be in good shape, but if it goes through, then we could be another leg lower.
Could they be a takeover target? Quickly?
It's always possible. You never know, but there's very few companies that have the financial wherewithal to buy them out, and to take on something that has this kind of public relations attached to it would be a little more dicey for some of their competitors right now. But going down, looking down the road, never say never.
Apparently Exxon has been rumored.
Well, yeah, I mean, they're one of the ones that would have the financial firepower to do it.
Yeah.
But again, given the PR things that are happening right now, I think that's too hot to handle for them.
All right, thanks for being with us. We'll have to keep our eyes open on this one in the weeks ahead. Roundtable's next. You won't want to miss it. Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. What are the main market drivers now, and is the market pricing in a global paradigm change, whatever that means? Our panelists weigh in: Editor-at-Large Steve Reitmeister, Resident Research Director Shiraz Mian, and market technician Kevin Matris. And Kevin, I want to start with you this time because it was noted on the wire earlier this week that, in fact, it is some analysts' opinion that such as Mohammed El-Arian,
Right.
that technicals now are beginning to overshadow fundamentals as far as market driver is concerned. Do you agree with that?
You know, I am going to agree right now. As a matter of fact, I think it's the technicals that has actually caused me to adopt a more bullish bias as of late. And for me, it all started with the follow-through day that we had seen on Tuesday. So in short, after you see a correction or after you see a down move, the very first up day you see is considered to be day one. Day 2 and day 3 are not that important as long as it doesn't undercut the low of day 1. But ideally, what you want to see is on day 4 through 7, you want to see the market make a big move to the upside. Typically, you need to see at least a 1.7% increase. And you need to see this happen on increased volume. And that is exactly what we saw on Tuesday. And that was actually day 6 of the count. Now, what's interesting too, and what in my opinion makes this follow-through day, the technicals all the more impressive, is that the follow-through day got us back above that 200-day moving average, which everybody seems to be looking at. And once we got above there, we have been above there ever since. So your technicians out there will look at this and they will say that the probabilities that the correction have run its course and that we should be able to move higher. So I am looking for the market to be able to test maybe even as high as 10.7 and possibly even press the upside even more. So I think the downside for the most part probably is over at this point.
Okay. Steve, let's get into this paradigm shift, paradigm change. Basically, that means the new normal, right?
The new normal is something that Mohammed El-Arian that you just talked about, he and Bill Gross, both from PIMCO, have been talking about. The idea is that after decades of over-leveraging our society, that we now have to go through deleveraging. If you deleverage corporations, one of the natural outcomes is going to be a lower growth rate. If you have a lower growth rate, then most likely then the PE that people are willing to pay for the averages on the stock market have to come down commensurately. Meaning, if you're used to 10% earnings on the market, you might be willing to pay a PE of 15. If the growth rate is going to be more like 6 to 8%, then the PE has to shift down a little bit as well. That might be exactly what just happened with this downturn from when we went from Dow 11.3 to 9,700, where there is now a repricing of risk into the new normal.
Shiraz, we're coming up to another earnings season here in a few weeks. Earnings, once again, going to be a main market driver going forward here?
They will be. In fact, we just building on the paradigm shift discussion that you guys started, the reappraisal of the growth outlook for the U.S. economy and then the earnings power of corporate America, we will start seeing evidence of that. If any of these global changes, the sovereign debt issues in Europe, the growth outlook risks to China, if any of those fears and concerns are putting some brakes or moderation on the U.S. economy and the earnings power, I've always been concerned that there's downside risk to the S&P 500 earnings. My sense is that as we get closer to the earnings season, pre-announcements and then actual announcements and the outlooks from management teams will give us more clarity on that. So yes, it'll be a driver.
Kevin, as far as structural change is going with what we're witnessing here, that's actually what we're talking about, structural change. Investors encouraged to keep an eye on the health of the balance sheets here going forward?
Yeah, I mean, I do think that's very important. You can see that your households and your consumers, we are pulling back on our debt. We are delevering, but I think it's been written about ad nauseum that governments are just increasing their debt load. But what's interesting about this new paradigm is slower growth isn't necessarily bad. I mean, we keep on having these big boom and bust cycles, and the distance between the boom and the bust has seemingly gotten shorter and shorter and shorter. If we can grow at a slower but sustainable pace, hopefully when we finally do go through the inevitable economic correction, it won't be as devastating.
All right, I want to get Steve in here one more time. It's also being talked about now that markets may be testing lows here sometime during the summer. What do you think about that?
I think we maybe already did that when we pressed towards 9,700 on the Dow, and now we've had a nice spring back. Kevin talked about the technicals. We got above the 200-day moving averages for all the major indices this week, and have held that level, which is a very important sign that we probably don't need to be retesting the lows anytime soon.
All right. As long as we're here with you, give us your stock pick of the week.
Yeah, I went with Stephen Madden, shoemaker.
The John's son?
No, not
Oh, okay.
But Stephen Madden, one of the things about the shoe industry right now is it's a very modest luxury. So as people start to open up their wallets, they just want something that's very simple, that makes them feel good about themselves. Shoes is a good place to be, and they're definitely a leader in that category.
Shiraz, your stock pick.
I'm looking at Chipotle Mexican Grill, ticker CMG. It's a $4.5 billion market cap fast food restaurant operator with about 1,000 stores in the U.S., primarily exposed to the U.S. economy, a very stable, relatively low risky, and very visible growth profile. We're looking for about 15-20% earnings growth and about 12-15% upside over the next 6 to 12 months.
Okay, did you think about that over lunch one day?
I actually plan to go to Chipotle.
Mr. Matrix, quickly.
My pick is Sprint, ticker symbol S. I rarely will even look at a stock under $5, but they were the first to come out with a 4G handset. They have a winner with their new phone Evo. They're selling contract-free phones at Walmart, and they have a new device, which is the mobile hotspot. I think there's a lot of growth there.
So old habits don't die hard.
Apparently.
You actually think that they can take over market share from people in that smartphone space already?
Look, I think the iPhone is the greatest thing out there, but not everybody thinks that, and I believe there's a lot of people who are going to go to that other phone.
Okay. And that's it for this week here at the Roundtable. Thank you for joining us. We hope the week ahead for you is a profitable one, and we'll look forward to seeing you next time on Profit from the Pros.